Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the show where you can have your property related questions answered by our team of experts. And joining me today is Zee Razaq, CEO of Certax, Property Taxation Specialist. Welcome to you, Zee.
Thank you for having us, Stephen.
And Jermyn, first time on Property Question Time.
Yes, it is. Thank you.
Good to see you. Welcome. Carly is CEO and Solicitor at Woodstock Legal Services, Residential Tenant and Law Specialist. So there we are. Okay, now what we're going to do, we're going to start off with you, Zee. With the difficulties in the current economic climate, along with higher interest rates, are the panel seeing any resistance from lenders in respect of financing either buy-to-let propositions or residential developments? If so, do the panel expect an easing of lending criteria as interest rates and hopefully inflation falls? It seems to me that these are critical factors in affecting the supply of housing both in the sale and rental markets. Now, I know you're a taxation expert and not necessarily a banking expert, but I know you've got a lot of developer clients and you must be getting the feedback off all of this.
I did work in banking for a few years, so I got a little bit of knowledge on it. Yes, we are seeing a bit of issues, especially when the interest rates were rising quite rapidly and it was a bit of a shock to the economy generally. And what we're finding is that clients are requiring, or lenders are requiring from clients a lot more information. And this is where your accountant, tax advisor, business advisor comes in, because we have to provide that financial information. They tend to go further back now. They also want more robust forecasts and also what you're factoring in as the interest rate. So depending on what your strategy is and when you're doing it, the rates are becoming a lot higher. So I tend to benchmark at least 8 to 10% at the moment, because you've got to have some wriggle room. And so this is really affecting what is a profitable project, especially with margins of buy-to-let are so low at the moment, because people haven't factored in all of this. So they're going to need better value, better negotiation on what deals they go ahead with, whether they're doing it as a property investor or whether they're doing it as a property developer. Hope that helps explain where it is.
Or I suppose whether they're just holding an asset. I mean, there's still a cost, isn't there, both in terms of time and in terms of interest rate, and it's got to be factored in, or else you're just going to end in trouble, aren't you? I mean, same as all these people that have signed, heat and light inclusive contracts in HMOs. They've got 12 months to run, and pretty stymied at the moment, aren't they?
But on the flip side, inflation is actually your friend if you're an investor, because
I sit at home hoping my flats keep going up in value. Yeah,
absolutely, but your debt's going to go down in real time. So this is where people probably need to get that balance right. The interest rate, as long as your cash flow covers the interest rate, and I think we've done that in a prior episode, that is obviously the key. But anything above that, where the inflation is above the interest rate, is actually you making money by holding other people's money, because your debt in real terms is worth less. So this is where property investors have got a bit of a mixed fortune on this.
Are you finding though that the institutions are being generally more selective in what they lend on, or is it just the particular person's track record or particular circumstances that they're looking at?
It's interesting you say that. I just got a request late yesterday and they wanted an essay, literally, of all the items. I have to speak to the client and say, is some of this relevant? Because I think they're becoming overcautious because they don't know. People in finance, especially when they're lending money, one of the key things is stability and certainty. When they don't have that, they tend to become very risk adverse, and that's what's happening. So they want more information. How long have you known the client? What's your view on the client?
So are they testing you at the same time?
They can try, and that's what's happening. But yeah, they want to know what the relationship is. How much is the financials that you're giving? How robust are they?
Well, I mean, a lender can come back at a surveyor, can't he, if he gives wrong information or makes a wrong judgment on the valuation. I mean, in some ways, I suppose you ought to be on the hook in the same way if you're vouching for somebody's financial credibility.
Really good point, Stephen. Always loving getting value, Stephen, right? To something called an accountant certificate.
Do you mean I'm being difficult with it?
No, I love the questions because this is what it's all about. Being a chartered accountant or a tax advisor, one of the criteria is that you can do something called an accountant certificate, which validates what numbers you're putting on there. So we have to make sure the numbers that we're basing those are robust and they're based on robust information. And I think that's the key, and that's why you get a professional involved to help you get the finance.
Yes, okay. You got anything to add to that, Carly? Are you finding your clients having difficulty getting money at the moment?
Yeah, definitely more challenging. And like I've heard, clients saying being asked a lot more questions. Yeah, so definitely a lot more challenging.
Okay, Carly. In the past, if you were owed money by a house owner, it was possible to place a charge or a caution on their property to secure the debt. I understand from land registry that this is now a facility that's no longer easily available, and I think that might be the key word. Can the experts advise on how one can secure a creditor's position against solid assets?
Yeah, I mean, if you're looking at it from an agreed loan perspective, I don't actually think it's as challenging as people think. And as long as the process has started when the loan's agreed, it can be registered and secured and will fall below in priority under any other previous lender, so mortgage, for example. I tend to deal with it more when there's been some litigation and there's a debt that's owed. And the process we need to go through is to first obtain a CCJ, and then we can apply for a charging order over the property, and then we go and get that, once it's made final, that charging order registered.
But
we do that quite frequently.
At one time, land registry just used to look at it, and if it looked sort of fairly sensible, they'd allow the charge, wouldn't they? And you just have the opportunity as the house owner to come back and challenge it if you so wish.
Yeah.
I think that was the original process, wasn't it?
Yeah, and there still is, you go for an interim charging order, they can challenge it at that point, and then it's made final, but we tend to get most of them made final. By that time, it's pretty black and white. The challenge is actually releasing those funds. So once you've got your charge, you either sit and wait until it's sold, but what if it's not sold and it sits there for a long period of time? What you're looking at then, which can be more challenging, is going for an order for sale. And there's loads of factors that a court will take into consideration then. The size of the debt compared to the amount of equity in there, whether there's children, elderly living in the property. At the end of the day, to do that, you're forcing somebody to sell their property. And if the debt's really small, they may take a view on that and decide it's not reasonable in the circumstances. So they'll consider the whole picture. So that's normally where the challenge is. Okay.
Well, that seems to be a fairly balanced approach. I mean, I quite like that. I mean, I've seen in the county courts in particular, who I personally think are the wrong people to be adjudicating on housing and property matters. I think there ought to be really a specialist court in a way, because it's so difficult now. Yeah. And we've got the advent of no-fault evictions coming up. With the greatest respect to county court judges, I'm not sure that they're that qualified
it's really difficult
to adjudicate. Yeah. Would you agree?
Yeah, I completely agree. And I think it's a complex area of law. When I first started as a litigator, I used to do a bit of residential landlord and tenant law evictions on the side. It was easy, Now it's incredibly complex. You need to be specialist, and we've got reforms coming in. It's going to be even more challenging. There'll be most evictions with Section 21 they'll need to be before a judge. And no, we don't have specialist housing judges. And 1 minute you're sat listening to a family case, and then the next minute it's housing. That's difficult. We've moved away from lawyers and judges being a jack of all trades. So yes. It's a real challenge, I think.
But any kind of legislation is a bit difficult when I think we're on our 14th housing minister in 10 years. I think.
Yeah, we are. It's crazy. Revolving door, I think. So yeah, it's be interesting to see what happens with the reforms. They're no doubt coming. But it'll be interesting to see how quickly that moves.
I think it's very difficult, is it not, for especially for the small buy-to-let investor that's perhaps bought 2 or 3 buy-to-lets. I know you're not allowed to have a buy-to-let in a pension, but there's nothing to stop you having a buy-to-let being your pension, is there? There's nothing to stop you it being a de facto pension, and you've got all these new regulations coming in that you need absolute legal advice on everything, don't you now? I mean, it's just...
Yeah, it's, and for a long time it's become more and more regulated, and they're pushing for a more professional landlord, which they've been doing for a long time. So I think for your one-off accidental landlords, it's really tough. I still think it's a great market for those that, are serious about it and are probably doing it in higher volumes. And we are seeing that trend. I think, I've had my own property as an investor myself since I was about I'm trying to think now, 22, 23. So, but, you know, it's challenging, and to run that along, you know, to deal with that alongside a business, you know, is really difficult. So, you know, even though that's my specialism, it's the amount of time and attention and focus it needs to run that successfully, to have a successful portfolio. So that's why it's economies of scale, isn't it? And it's, you know, gearing all your attention towards that portfolio. So you can see why people are tending to go for the bigger numbers.
Yeah. And, you know, coming back to Zee's point about, you know, the profitability of these things, I mean, the cost of legal advice, professional advice, I've got two professionals sitting there, so you're going to twitch about what I'm going to say next. But, you know, it is quite a serious expense, and you do need to make a sort of positive sort of contribution allowance, don't you, for that? Would you'd recommend that?
Yeah, and I think just adding to Carly, what I commonly see is the charges of limited companies when they're properties, and seeking good legal advice. I emphasise that people like yourself, Carly, is so important, because I see it done not well often as well. Because the client comes to us and I'm like, "What's this at Company House?" I had one recently, which they didn't even go through the lending, but there's a charge on the company.
Okay,
and I'm just like, are you aware there's a charge at Company House? And I'm like, so when you said that they're becoming a bit tighter, I've not seen this. I've seen them actually, they just take it on face value.
How do you go on, Carly, when you've got all this data protection stuff? So when the lender starts feeding out information about the loan to land registry and you know, every man and his brother to try and secure it, is that not contrary to?
No, it's fine. Yeah. So
how do they?
Data protection's like my nemesis. It's you know, and you think it wasn't ever designed for, you know, it was designed for, you know, big organisations, and we're having to grapple with it constantly. It's a real headache, and actually, you know, it shouldn't be getting in the way of, you know, necessary transactions.
No, it shouldn't.
No.
It probably does.
Yeah.
Now I can always remember a High Court judge saying to me about in court, he said, if somebody comes in and starts arguing about it's affecting their human rights, he said just look them in the eye and ask them which particular one.
Yeah.
So I think that's the same thing.
Yeah.
Okay, well, that's all we've got time for in this half of the show, so join me again after the break when we'll be asking Zee and Carly more of your questions. Hello, welcome back to part 2 of Property Question Time with Carly Jermyn and Zee Razaq. So welcome back, both of you. Zee, I think your second question. I have a small development company with a turnover of around £20 million. Both my children are now of age, and I wish them now to be part of the company. If I issue them shares in the company, will this simply give them a tax bill based on the company's balance sheet worth and their percentage of holding, or are they allowed to accept shares without liability? I think we've done a programme on this before, haven't we, or something similar?
Similar. Love this question. It's a fantastic question. And small developer at 20 million, interesting. There's actually a couple of options here, at least, for this person, assuming they're emphasising it's a development company, which means a trading business. And therefore, you can claim something called gift relief, provided you meet the criteria. And that can be quite beneficial because you can gift it to your children. And therefore, you basically, we can use some technical words here, joint election, you let HMRC know this, and basically you transfer your cost of what you paid for them over to your children, and there's no tax.
But if you had them from the beginning, the cost was zero.
Well, it'd be whatever, it'd be £100, whatever, depending on how much shares you're doing, provided you meet the criteria. But option number 2, and this is quite important, is basically you can claim entrepreneurs relief or business asset disposal relief, provided you meet the criteria, because it's a trading business and you can sell the shares. And this is where the planning comes in, and speaking to a right advisor about this, because you may want some money on your exit. You may not want to give them for free if you worked all those years, especially if it's a 20 million.
Yeah, but you're not going to charge the kids that, are you?
You can do, and that's what a lot of people do, to be honest. They sell the shares to their children and they break it up in portions, because therefore you can claim allowances.
Is this what our unmentionable party chairman was doing?
I think that was slightly different what he did, and I think we've got to be careful before we get into that one because we'll be speculating. But for this is legitimate family planning, and this comes back to having that conversation: how you're going to exit, what does the parents need, and what do the children need. So I've had a number of these examples where people have said, do you know what, we're going to have so much. We can actually combine both of these if we do them in a smart way, that some of it I'm going to gift, and then some of it I'm going to actually sell at market value and claim entrepreneur's relief or business asset disposal relief. What means is that you charge 10% on the capital gain. The child who is receiving the shares will pay 0.5% because it will be over £1,000.
So are you in essence suggesting that then that money could just be taken out of the company? So it's not the company that's going to benefit from passing or subselling its shares?
The way you do it, there's two ways of doing that. One is the actual individual buys it, but a common way is the company buys back the shares. Right, so you do need clearance
and then
of HMRC.
Redistributes them?
Yeah, well, if you buy back the shares, you're actually removing the shares because it's buying them back. So whoever owns the company ultimately will then benefit. So that way, they're still using the money within the company to buy back the shares, and therefore it's actually quite beneficial. So you can do a combination. Some of them you gift, and some of them you claim entrepreneur's relief up to the relevant thresholds. And this is really tax efficient. If you think about capital gains tax, where it's at on shares, you're likely to be paying on that kind of size company 20%. If you claim entrepreneur's relief, it's 10%. That's massive.
Now, look, Zee, clever as you are with all these tax ideas, we're not quite answering the question, are we? Which is, can he give these to his kids without them incurring a liability?
I told you there's two options. One, gift relief.
But that does incur a cost, doesn't it?
The gift relief, there is no tax. That was my first option.
Oh, right, okay.
Right, so you gift it, do a joint election. Stephen, go listen to my answer. I've got to be probably more clearer. You can pass it from the parent to the child, right, and do a joint election, but you're gifting the shares to them.
But let's say he's got 20 million turnover. Let's just say, for argument's sake, the balance sheet worth of the company is 20 million, and he gives the child 10%. Is he not gifting £2 million to the child?
No, because he's doing an election to say that his base cost of what he paid, he's giving that to the child, so and the child is signing that I'm agreeing this. Because the reason being is, if the child then sells it in the future, they won't have a base cost of 2 million. They will have a base cost of whatever the parent had at the start. That's the point of doing a joint election. Right? And that's what we call gift relief.
But is there no downside to that?
The downside is that the parent gets zero because they're gifting it.
Yeah.
So, but if they want to make some money on the exit, they go down option number two.
That's the difference.
And that's where you want to make sure. And the benefit to the child is obviously that the base cost, if they do buy it, or depending which way they go.
Will be the cost of issuance, won't it?
Absolutely.
Okay.
Hope that answers the question.
Thank you. Yes, and I'm not going to ask you for any comment on that. No, I think we get it. Okay. Carly, given that the basic purpose of land registry hasn't changed over the years, could it be time for repurposing? Solicitors often need to prepare reports on title, and it occurs to me that the land registry could be used as a one-stop shop for collating all the relevant information like flood reports, assessments, registration of contaminated land, planning issues, and all the issues that one would need to report on. This would, in my view, save much conveyancing time and indeed cost. What do you think to that?
Oh, don't agree, I'm afraid. Nice idea. Wouldn't it be lovely to have a one-stop shop? In theory, that would make it a lot easier for a conveyance. You had one place to go to gather all of the information you needed to be able to report on that title. But unfortunately, land registry are, under-resourced, underfunded, and still dealing with a bit of a post-pandemic hangover. You're looking at simple title registrations can be up to 2 years. And if you're expecting them to then add to their service when they're not actually performing on the one they're currently dealing with, I just can't see it working. You think you've got to look at training staff, systems and processes, gathering all of that data. And I actually think that's a huge hurdle, and I can't see them being able to deal with it in the foreseeable future. And I think as well, for me, a concern would be that you take a little bit of the competition out of the market as well, because right now you can go to the, search providers that offer the best service, the best turnaround, and if you're going from one place, that gets rid of that competition. So I don't necessarily think that's a good thing. I think it would slow things down.
Do you? I mean, I look at it from somebody who, in the past more than now, got involved with the sort of transactional side of the business, and I've got 2 or 3 points. One, if you're trying to find comparables or you're trying to find evidence of prices across the country, then obviously the most reliable form of information is from land registry on what's been registered. I mean, that's the only true thing. But the trouble is, nowadays, it's 3, 6, 12 months behind before you get the right information.
Yeah, if not more, yeah.
So for me, that negates part of their worth.
Yeah.
On top of that, you've then got solicitors who, choose my words carefully here, in every profession, have really good ones, average ones, and sometimes not so good ones.
Yes.
Okay.
Yeah.
And the guidance on what should or should not go in a report on title can sometimes be a little bit vague, and certainly sometimes a little bit incomplete. Yeah. So I think I quite like this idea, albeit that I'm not somebody that would have to enact it. So.
Yeah. I think the idea in theory makes sense, but I think in practice, I think they've got a long way to go to be able to even consider it. They need some serious funding to go in there.
Right. Okay. Well, just as a sort of short follow-on from that, what do you think could improve conveyancing speed at the moment?
I think solicitors have driven down their own fees for a very long time, which is ironic that I would say that, but and I think they've had to go for the high volume, stack them high, and price them cheaper, and I think that's caused them to, when you're working in such high volumes and it's a high risk area, it means that there's a tendency, and I think perhaps new generation of lawyers coming through being incredibly risk adverse, asking too many questions that don't make commercial sense on certain transactions. Email, I think, has killed it a little bit as well. So I think, getting back to picking up the phone, being a bit more sensible about the questions they ask, and moving away from high volume transactions and actually having a sensible caseload that you can deliver a proper service on for a decent fee. And I think that would free up, it would free up a lot of the market, and the conveyancing transactions should progress quicker.
That argument to sort of stack them high, again, can apply to, I don't want to tar everybody with the same brush, but some valuers, and especially some of the really big ones that do the volume work for some of the building societies and banks. They purposely undervalue because it takes them nowhere near their insurance, for their liability to lenders. I mean, the simple fact is, if they undervalue, then it's great. They don't go anywhere near that insurance. They're never going to get criticised. But the damage that it can cause to a family, for instance, if the valuer just thinks arbitrarily, I'm going to downvalue this by 20% and nobody dare argue with me, it's very dangerous. Causes a lot of problems, a lot of heartache in families. And, on top of that, the trouble is, you say, well, that's all right, get a different valuer, get a second opinion. But as often as not, you can't, because the bank will say, no, they're not on our panel. That's not who we use. They're 4 times the cost. These people do it for 150 quid. These people want 1,000. And the trouble is, all these things, because we are computerized now, the trouble is, even these low valuations, they're put on the register. And a lot of other valuers will just look it up and say, oh, this was only valued last week, so I'll just do the same. How can I be different? And this sort of pilot high business is not always good, is it? No, and I think it creates risk as well. So it's it's not something we champion at all. So I think it's Right. Well, there we are. That's all we've got time for in this show. So great big thank you to Jermyn and Zee Razaq for their wonderful answers to your questions. Very professional show. Join me again next time on Property Question Time, where we'll be asking more experts, more of your questions. I'm Stephen Galpin. Look forward to seeing you then.